Good morning and welcome to our first LME webinar, which is an introduction to LME swaps, a new product which we are launching on the 23rd of January. So what exactly are LME swaps? Well, they are a two-part cash settle contract which fixes one side, known as the fixed price, either as a purchase or sale, and cash settles that against a floating price, which will be the LME monthly average settlement price for the relevant month. So a buyer of an LME swap would buy at the fixed price and cash settle against the floating price at the end of the prompt month, and the seller of an LME swap would sell at the fixed price and cash settle against the monthly average settlement price. So we can now take a look at an example of a company who wishes to buy at a fixed price, and they ask for an LME swap quote for March 2012, and the quote is $2,000 bid, $2,010 offered. So the party agrees to buy at the fixed price of $2,010 a ton, and this will be settled financially at the monthly average settlement price on the last business day of March. Now, if the MASP settles higher than $2,010, the party will receive any difference on the first business day of April, the following month. And if the MASP settles lower than $2,010, then the party will have to pay the difference on the first business day of April. So who would be likely to use LME swaps and why? Well, the majority of physical business is transacted using the LME price as a reference. Sometimes that price might be for one particular date, for example, buying physical metal basis the LME settlement price for the third Wednesday of March, and then a hedge can be put in place using a futures contract for that particular date, and then that would need to be closed out when there's no longer any price risk, which would be the day that the physical metal is priced, and that would then be the third Monday of March when the settlement price for the third Wednesday is discovered. If, however, metal is priced in or out basis the LME monthly average settlement price, then the hedge should also be closed out on the same basis. So producers, manufacturers and consumers can use this product to match their hedge perfectly with their pricing formula. And here we can see the metals value chain, which explains how each sector can use the LME as a reference price when agreeing a physical trade. The LME price itself, which we can see in the center of this diagram, represents a semi-fabricated product, LME brand metal, in warehouse, duty-free, and the settlement price is for delivery or cash settlement in 2 business days. So any physical trade of metal of a lower grade than the LME registered brand could still use the LME settlement price, but it would be discounted to reflect the lower metal content. As we've mentioned, LME brands are all semi-fabricated products such as copper cathodes, aluminium ingots or steel billet. And any product which is more refined than that, such as copper wire, aluminium coil, cans or steel rebar, will again still use the LME settlement price as a reference, but premiums will be added to reflect production costs and a profit margin. So all these sectors of the value chain are using the LME price to buy and sell physical metal. Normally though, rather than using the LME price for one specific date, they will take an average price for a month. And why would they be likely to do that? Well, as we can see from this graph, using an average price smooths out any spikes and dips in the market. Now, these prices might not truly reflect the current supply and demand and would usually be rectified within a day or two. So it makes sense to price metal on the monthly average, as we can see from this aluminium graph for December 2011. anyone who was pricing in metal at the beginning of the month, if they chose the first few days of December, would have paid a much higher price than the average, which was $2,021.78. And anyone who was selling metal basis a particular date towards the end of the month would also have been at a disadvantage, as they would have sold their metal at less than the monthly average. So it makes sense, therefore, to take an average price, and many sectors of the industry will do that. But they use different formula, and we'll have a look at those in a moment. So how do we arrive at this monthly average settlement price? Well, the settlement price is discovered every business day of the month. So for example, for December 2011, as we can see here, the first business day would have been the 1st of December, and the last business day the 30th. So the prompt dates for the month of December, all the settlement prompt dates, would be the cash date starting from the 5th of December, which was the cash date for the 1st of December, and ending with a prompt date of the 4th of January. So you actually go into the next month, because the final trading date or fixing date for settlement would have been the 30th of January, and the cash date, the 30th of December, sorry. So the cash date for the 30th of December would have been the 4th of January 2012. Note that when there is a non-prompt date, such as a US holiday, the 2-day prompt rule applies. So for example, in November 2011, the 24th was a US holiday, so a non-prompt date. So therefore the settlement price for 2 transaction days of the 22nd and 23rd would be the same. It would have been the 25th of November, the settlement price for both those days. So here we can see some typical pricing formula. I've already talked about the fact that many sectors of the industry will use the LME settlement price for an average period, usually a calendar month, and they would then fit that in with different types of physical pricing. So M-1 is pricing the month before the month of shipment. M is pricing during the month of shipment, and M+1 would be pricing month after month of shipment. So for example, if a converter buys metal for shipment in July on an M-1 formula and wants to hedge this using an LME swap, they would buy the LME swap for June, as this is when the metal will be priced, the month before month of shipment. So before we go on to look at an example of a hedge using LME swaps, I'd like to take a look at the contract specifications. The trading platforms for this product are LME Select, the electronic platform, or the 24-hour telephone market. The settlement date is the last business date of the month. That's when the contracts are settled for differences. And the payment date would be 1 good business day after the settlement date. So effectively the first business day of the month following the prompt month. The minimum trade size is 1 lot, and the minimum price fluctuation is $0.01 per ton. The currency is US dollars, and the last trading day for an LME swap would be the last business day of the month before the start of the second ring.